Hello and welcome back to our trading course. Please remember that this presentation is for educational purposes only and should not be considered as trading advice. It is always best to test your strategies first on a demo account until you make your own decision if it is something you want to use for trading with live funds. Today we'll be covering several trading strategies, but before we get there, I will quickly show you some additional tricks and tools on MT4 platform which were left out from our last video. So let's get started. Something that will be very useful for any trader is drawing lines on the graphs. You can draw trend lines, horizontal lines, as well as vertical lines. All of them can be found over here. By default, all your objects on the charts can be selected by double click, which can be inconvenient. So let me first show you how you can change that. Go to Tools, Options, then go to Objects and tick the box for Select Object by single mouse click. Then click OK. So let's quickly now draw a trend line over here. Click on it once and just click on the mouse and pull it. As you can see, by default, MT4 platform will show them as rays, which I personally don't like, but also that can be changed. So now, single click on the start of the line, right click on the line, then go to trendline properties. Now go to parameters and untick the box for ray. You can also change the way the trend line looks, the style, the color, as well as the thickness. Then press OK. As you can now see, it's just a line which you can move around as you want. If you want to move the line, just click on the middle of the line and move it around. If you want to adjust it, either side, you can pull it like this. If you want to delete it, just press delete on your keyboard and it will be gone. If you want to make a horizontal line, just click here and then click on the screen with the left button and there you go. It is very simple to move this around. Just left click on the line once and you can move it around. And you can delete it the same way on the keyboard or right click on the line and press delete. Same thing is with the vertical line. You can move it around exactly the same way and delete it. Under insert, you can also use all kind of other shapes and arrows, but I will let you investigate this part yourself. But here are the different shapes and here are the arrows. Alright, instead let's now move on to limit orders. Limit orders let you set up orders so that when the bid or ask price hits them, it will enter you into a trade based on your preset parameters. There are 4 types of orders you can set: limit buy, limit sell, buy stop, and sell stop. Let me show you each one and how they can be used. Let's start with a limit buy. This is used when you believe that the price will be going higher below the current price. So let's say that we believe that US dollar CAD pair will go up from 132.78. So we right click here on the chart and click buy limit, and it enters the limit right away, which you can now adjust by just clicking with your left mouse on the line and dragging it around. You can also set up stop loss and take profit by double clicking with your left mouse on the line. Here you can set up the stop loss as well as take profit. Sell limit is the opposite of buy limit. If you think the price will be going lower from a higher point than the current price, you can set it up exactly the same way as shown with a limit buy. Just above the price, right click, sell limit, and it's there. Now let's move on to buy stop and sell stop. These order types are often used with breakout strategy, which we'll be covering later in the video. Buy stop is an order which is set above the current price level. The thought behind such order is that if the price goes through a level, then it should not continue higher. Sell stop is just the opposite of that. You can place the order by right-clicking on the chart, then go to trading and go to new order. You can also use the shortcut, which is just by clicking F9 button on your keyboard. Now all you need to do is go to type and choose pending. Under pending order you just choose buy stop or a sell stop if it's for the other direction. Now we're going to choose buy stop. Here you can also choose the stop loss as well as take profit, and all you're going to do is adjust the price at which you want it to happen. Let's say 1.33, big figure, and click place. Now you have it over here. You can also left double click on it and you can adjust the stop loss once the level gets hit. So let's say 1.328. So now when the price goes through this level, it automatically puts you into the trade and puts the stop loss there as well. For sell stop, it is the same thing, just other way around, and you will place it below the market price. If you remember, in the last video I mentioned to add the ask line on the graph. This is because buy positions get executed at the ask line, while sell positions get executed on the bid price, which is the default price line by MT4 platform. Therefore, you have to be careful when you set up your take profits, stop losses, and different orders. This is because stop loss and take profit orders on buy positions are triggered when the bid price hits the order level. Stop loss and take profit orders on sell positions, however, are triggered when the ask price reaches the order level. Buy limit and buy stop orders on a position are triggered when the ask price reaches the order level. On the other hand, sell limit and sell stop orders on a position are triggered when the bid price reaches the order level. Alright, I think you are now ready to move on to some actual trading strategies. First, let's start with the basics. What is support and resistance? Support and resistance is used as a tool to perform technical analysis. It is a concept that the movement of a price will stop and reverse at a certain predetermined price levels. These levels are often denoted as a price level which is touched by multiple times. Therefore we get support, which is considered as an area for buying, where market participants are supporting the price and not letting it drop any further. Resistance level is the opposite. Sellers are not letting the price go any higher due to heavy selling. Here's the idea of support. As you can see, often it may appear that the support or resistance was broken, but it is actually not the case. Also notice how the bodies of the candles respect the support line. This is key, remember it. Here is a quick example of a resistance line, but let's have a look how you can actually trade it. Often what happens is that support turns into a resistance after breaking through the level or other way around, and here is a clear example of that happening. As you can see, the price worked the level many times from both sides. These levels are often considered as institutional level. The more people trade from the same levels, the more likely they are to move from it. But enough with the basics, let's move to the next strategy. Let's discover what are the Bollinger Bands and how you can use it to your advantage. Bollinger Bands is an indicator which comes with your MT4 platform by default and is a volatility indicator which is similar to Keltner channel in case you have not heard it. If not, you might want to note it down and look into it later on. Bollinger Bands were developed by a famous technical trader called John Bollinger. It is said to plot two standard deviations away from the simple moving average, and therefore the price is bracketed by an upper and lower band along with a 21-day simple moving average. Moving average is something we're going to talk about later on. But as standard deviation is a measure of volatility, the bands widen during volatile periods and contract during less volatile periods. The trading strategy is based on entering trades at oversold, overbought, and the mean areas, as 90% of the price action occurs between the two bands. This is what it would look like on the chart. As you can see, the price line in the middle is the 21-day simple moving average, and it is considered the mean price. Then you have the two brackets around it. If the trend of the instrument is up, you should be looking to buy either from the mean price or from the lower band. If the trend is down, you should be selling at the mean or upper band, which would be considered overbought. In order to add the indicator to your chart, go to the indicator icon, then to trend, and Bollinger Bands. Now change the period to 21 and click OK. Let's move on to a scalping strategy with stochastics. What is stochastics? It was developed by a famous Dr. George Lane in the late 1950s for technical analysis. Stochastic oscillator is a momentum indicator that uses support and resistance levels. It refers to a current price in relation to its historic price over a specific period of time. It looks for overbought and oversold areas from which you could either look for a short or a long position. Above 80 is considered to be overbought, so you would look to sell, and below 20 it would be considered as oversold, therefore you'd be looking to buy. However, every instrument should be considered separately as they may vary in levels. This indicator can be added by going to the indicator icon, and then you will find it under oscillators. As you can see from this 5-minute chart, it provided a lot of opportunities to you to either buy or sell. If you take 5 pips per each trade signal, by the end of the day there's no reason why you shouldn't be up by 50 pips. Moving on to one of my favorite strategies, which is trading with a trend, while using moving averages to enter the trades, as well as exit them. So what is moving averages? They are one of the most widely used technical indicators. They often help to smooth out the price action by filtering out the so-called noise. It is automatically a trend following tool as it is based on the past prices. There are two types of MAs, simple moving average and exponential moving average. Simple moving average uses the simple average price of a security over a defined number of periods, while the exponential moving average gives a bigger weight to the more recent price action. Therefore, as one can be lagging behind, they are great while using together. For this reason, moving averages are used to identify trend directions, as well as support and resistance levels, and reversals. Let me show you how you can set up this strategy. First, you will need to add two moving averages, one exponential, set at 8 periods with blue color, and the other simple with red, 14 period separators. This strategy should be used together with support and resistance levels. If the trend is going up, you should look only for buy signals. If the trend is down, look for sells. Here is an example trade. The trade trigger happens when the moving averages cross. In this case, the trend was up, and as you can see from the chart, the moving averages crossed. When the new candle opens, you have the confirmation and you enter the position. Place your stop at the recent low. Exit would then be when the moving averages cross again. This strategy works the best on the hourly chart, but you can test it also on other time frames and see how it performs. Now we will move on to the last strategy for today, which is trading breakouts and fakeouts. If you remember, I mentioned them during the beginning of the lesson. This is where sell stops and buy stops will come very handy. This type of strategy is great in a ranging environment when there is no clear trend or is used during news announcements, hoping for a break in the market structure. It works very well also during high volatility periods. There are two types of breakouts, continual and reversal. Fakeouts happen after the breakout returns to the range and usually are found at support or resistance level. Those could be created by trend lines, previous daily highs and lows, or chart patterns. So let me show you now some examples. As you can see, we had a triangle forming, which can be a great chart pattern for using breakout techniques, as the price can either break up or down out of the triangle. Therefore, you can set your buy stop above the upper trend line and a sell stop below the bottom trend line. When it breaks, you should not expect the price returning to the range. Here we have an example of a fakeout. Of course, there are some additional things lining up over here. The trend line shows previous trend which got broken and then retested. Therefore, this fakeout was a perfect lineup with also other trading tools. As you can see, it is never enough to just use one tool. You will receive the best results by mixing a few tools together, just like we have done over here. This will give you a stronger trade signal. I would strongly suggest you to test these strategies and see what fits your trading style and personality the best. It will make trading much more enjoyable, as you will feel more confident when entering trades. We have now come to the end of day 3, and you should now have everything you need to know to get started with your trading career. I would also like to mention that we now post daily market reviews. If you want to receive them, it is best if you subscribe to our YouTube channel. This way you get instant notification when it is uploaded. If you have any questions, feel free to drop us an email and we will get back to you as soon as possible. Thank you for watching.